A lot of people strive to beat the S&P 500. A lot of people are content with the S&P 500's returns. What if I told you there's a way that you could easily beat the S&P 500? Well, you probably wouldn't believe me, but I want to show you anyway. The first idea to beat the S&P 500 is to use a daily leverage. How can you use a daily leverage? Well, there's plenty of daily leverage ETFs, but I'll get into that later. If we were to implement a daily leverage over the course of nearly 100 years, we would be able to easily beat the S&P 500. The biggest issue with daily leverage is under a short, volatile time frame, they can hugely lag the underlying. So in this case, over this volatile 6 days, we can see that the S&P 500 posted a positive return of about 0.5%, whereas the leverage counterparts all underperformed, and the 3 times leverage even had a negative 2% return. This volatility drag is an issue, but it's not the biggest deal over the long term. Another way to beat the S&P 500 is by using a moving average rotation strategy. And what that is, it's really simple. Let's just say you're talking about the 200-day moving average. When the market crosses above the 200-day moving average, you want to buy. When the market crosses below, you want to sell. And when you have sold, you want to be in cash or treasury bills, whatever it is. So in this figure, you can see that the S&P 500 produced these returns during bull runs. And the moving average rotation strategy with the 200-day produced a much worse return. That's fine because during the S&P 500 bear markets, the 200-day moving average rotation strategy protected from a lot of decline. Now, the market is not random at all. In fact, the market is much more volatile below selected moving averages than above. If we were to annualize the volatility on the 10, 20, 50, 100, and 200-day moving averages, it's quite clear that volatility is much less above these moving averages than below. Looking at these same moving averages and annualizing the return, we can see that above these moving averages, we're posting a lot of positive return, and below, we're posting little to none. Furthermore, the S&P 500 has most of its worst days below these selected moving averages. Above the 200 moving average, we're seeing more consecutive positive day streaks than below these moving averages. Once again, pointing that above moving averages, we're looking at more strength than below with less volatility. Now, looking at this table, we can see clearly if we were to buy and hold the S&P 500 from October 1928 to December 2020, we would post a 9.4% annualized return, which is not bad. Using any of the moving strategies, 10, 20, 50, 100, or 200, we would beat that return. But not only would we beat that return, we would beat it with a lower drawdown, which is pretty good. Now, selecting one of these strategies, it just depends on the person because there's a lot of trades that need to be taken with the lesser moving averages like the 10-day. Now, looking at just the pure leverage, we can see that all the leverage strategies beat the S&P 500, but they do so with a larger drawdown, which makes sense considering there's leverage involved. Now, knowing that the moving averages can mitigate leverage, and knowing that the moving averages can mitigate drawdown, and knowing that leverage can multiply our returns, we can combine these strategies. As you can see, the S&P 500 3 times leverage using the 200-day rotation strategy we can produce a 26.7% return compared to a 9.4% return on the S&P 500. This is all with an average of 5 trades per year, which is not too much. Using these rotation strategies with leverage, we can mitigate drawdown quite a lot, as I mentioned earlier. And this is just showing 5 bear markets and their drawdowns on the S&P 500 versus the leveraged counterparts drawdowns. And we can see, for the most part, with the leveraged counterparts, we're looking at less of a drawdown. Now, everything I explained before is all theory. Like if we were to use these leverages without any cost, which is just simply unrealistic. Now, if we were to implement the actual practicality, we can't backtest all the way back then since there weren't leveraged ETFs back then, but there are since roughly 2009. So looking at SSO, which is a 2 times leveraged S&P 500 ETF, and UPRO, which is a 3 times S&P 500 leveraged ETF, we can see that these ETFs lose a little bit of percent compared to the theoretical value we should be looking for, but they still heavily beat the S&P 500. We can implement all the strategies mentioned with these leveraged ETFs, and through this run specifically July 9 to December 2020, it's pretty clear that the buy and hold of these leveraged ETFs would have outperformed the S&P 500 and the rotation strategies, but if the market was worse, more volatile, not as bullish, these leverage rotation strategies likely would have been superior. Now, one thing I would like to personally add is all these strategies only consider one lump sum investment and the return that you'd achieve. If you were someone like myself with a long time frame, unworried about potential drawdown, I think it would make sense to buy something like UPRO or TQQQ and just keep dollar cost averaging in. These strategies avoid that big drawdown. But what if you were to take advantage of that big drawdown and keep buying dollar cost averaging in? That would probably produce a very beautiful return. As we seen earlier, the 3 times leverage S&P 500 buy and hold produces roughly 16% annually. This is despite the fact that you'll undergo potentially a 99.9% drawdown. And using a leverage rotation strategy, you're really just avoiding that. Buying and buying and buying throughout that drawdown would probably bring that 16% upward of 25% for returns. So anyway, implementing any of these leverage rotation strategies, leverage strategies, anything at all, really you can beat the S&P 500. Now the choice of your strategy depends on how much drawdown you're willing to take, but I would say the more leverage the better, and the shorter the moving average time frame the better. But anyway, thanks for listening, and I hope that you share this video with someone that you want to get richer. I've linked the article that all these tables are from below, and feel free to look into it to understand these concepts more deeply.